So my name is Karim Barigou. I will present a joint work with Daniel Linders and Fan Yang about two-step valuations. So I'm currently a PhD student at KU Leuven. So insurance liabilities, as you probably know, is typically a combination of traded financial risk and non-traded actuarial risk. So it means that when you perform the valuation of insurance liabilities, you have valuation in incomplete markets. So basically you have to combine two types of valuations, financial valuation and actual valuation. So what we mean by financial valuation is typically valuation that is based on financial market prices. Typically this is, for instance, the risk neutral expectation, where this Q is calibrated on market prices. And then you have, on the other hand, the actual valuation based on historical actual data info, and then also some actual judgment. So for typical example would be standard deviation, where this P is essentially based on historical data. So here's the global picture. So on the one hand, we can say that, let's say that we have two filtration, F1 and F2. F1 is about the financial risk. So, and then for this financial risk, we perform a certain financial valuation that we will call Pi 1. And then on the other hand, you have an actual valuation for actual risk, on which we perform valuation Pi 2. So why these circles are interconnected is because financial and actual risk can be dependent. So the usual way to perform, for instance, valuation in insurance liabilities, to assume that you have this independence between financial and actual risk. You perform an valuation or expectation or P for actual risk and expectation Q for financial risk. But if these two are dependent, so you have to take that into account. And also, where we are lying is in the global ellipse. I mean, the risk is not purely financial or actuarial, but it's a combination of both. So the question that we want to answer is how to value a claim S, which is in the general ellipse. So if you look at the literature, valuation in incomplete markets, what is usually done is to perform a two-step valuation. So the idea is to condition, here F1 is the financial risk, so you condition on F1, then you apply Pi 2, so a classical actual valuation, and because you condition on F1, in some sense you are projecting on the financial space, and then you apply an expectation or a Q. For instance, you can have a look at Perser and Statio, who propose a two-step valuation. Essentially, in this paper, we want to consider two directions. First, we want to extend this two-step operator where you do not apply an expectation or Q, but you apply a general covariant variation for the financial valuation. And also, we also want to consider the operator, but the other way around. Because here we condition on financial risk, and then we apply a financial operator. But a natural question is, why we don't perform the valuation the other way around? So we condition on actual risk, actual filtration, and then apply actual valuation Pi 2. So in some sense, if you want to consider the ellipse, you can project on the first circle and apply Pi 2. Or what we want also to investigate is to project on the second circle and apply Pi 2. Also, of course, we can consider this two-step valuation for general valuations, but in this paper we consider more specifically coherent valuation, because what is nice is that with coherent valuation you have dual representation. So for a reminder, a coherent valuation is a valuation that fulfills these four requirements: monotonicity, positive homogeneity, subadditivity, and translation invariant. So, and in fact, it's a natural generalization of a linear operator. In fact, one can show that a valuation is coherent if and only if you can express it as a supremum over expectation. So the intuitive interpretation is that a coherent valuation is in some sense a worst case scenario. Instead of, for instance, here you can consider a set of linear expectation and look at the supremum like a worst case scenario. Again, we are interested in this financial and actual valuation. In both cases, we want to consider non-linear operator. So, of course, when you look at financial valuation, you can consider the classical expectation or Q, but we want to go. We want also to consider a linear pricing rule, because in some sense, usually people use always this expectation or Q. But if you are in the market with, for instance, bid and ask prices, you will not have linearity. So we would like to consider not non-linear operator, but coherent valuation. A typical example would be to apply a distortion risk measure, rho GS, where G is a certain concave distortion function. Also for the actual valuation, you can consider a linear actual principle like here. Expectation under a certain change of measure, but ideally you would like to have some subadditivity, also to take into account diversification, and then in that case, a typical example would be an expectation, the expected shortfall, for instance. Now, we want also to discuss what we mean by market consistency. So, as you know, market consistency is an important requirement for solvency regulations. The usual way to define market consistency in the literature is this type of definition. It tells you that a valuation is what we call here strong market consistent if every time you have a financial claim S1 and you want to price S plus S1, this is the value of S plus the financial pricing rule for S1. So typically, the classical setting would be if here you have something that you can hedge, and then you had it, then you should have the expectation or Q for this S1. But the problem with this definition is that if you have this strong market consistency, you have directly the implication that a strong market consistency implies linearity. If you have this expression, you can find this linearity condition. So it means that you cannot have a strong market consistent valuation on the one hand and also a nonlinear pricing operator. So in fact, we have weakened this condition and we have proposed what we called a weak market consistency. So the idea of weak market consistency is only to ask that for financial claim, you apply the financial operator. So that's strong implies weak, but not the other way around. And especially weak market consistency, you can apply this with a nonlinear financial pricing rule. So now we introduce what we call the two-step financial valuation. So the idea is that here you have a pi 1 that prices financial claim, you have pi 2 that prices actual claim, and then you consider a conditional operator. So you condition on financial filtration, and then you apply. So here, in fact, when we condition on F1, so you have a quantity here inside that is financial. So it's logical then that the outer operator is the financial claim. That's what we call the two-step financial valuation. And what is interesting is that if you work in the current setting, one can show that, in fact, the valuation is weak market consistent, if and only if it has a two-step financial representation. So it means that, if everyone applies this operator, you would find a valuation that is weak market consistent, but also the other way around. If you have a valuation that is weak market consistent, you can have a two-step representation. And then now we also wanted to propose something quite new, is in fact this notion of actuarial consistency. In fact, market consistency is linked, it's about financial claim, but we could also propose similar definition for actual claims. Then we would define strong market consistency like this by saying that if you value a claim S plus an actual claim, you should obtain the value of pi S plus an actual principle on S2. But again, we have this problem of linearity, because if you have this requirement, strong actuarial consistency would imply that you apply, would imply a linear actuarial principle. So if you want to have non-linear actuarial principle, so that then you have to weaken this requirement and consider weak actuarial consistency. So weak actuarial consistency says that if you have a pure actuarial claim, you apply, for instance, a standard deviation principle. And then we, in fact, you can construct the same theory, but by reversing the role of pi 1 and pi 2. We can then define a two-step actuarial valuation. So now the idea of this two-step actuarial valuation, so you start from a claim S, you condition on your actual filtration. So what we mean by conditional actuarial filtration is that, for instance, you would simulate different paths of mortality, and for each path of mortality, you will look at what is the financial price for each scenario. And then once you have this, you can then apply pi 2, so an actual valuation. So we'll come to examples just after. And once you have this two-step actual valuation, following exactly the same proof as the other one, you have characterization of weak actual consistent valuation in terms of this two-step operator. So if you apply this two-step operator, you would find a valuation that is weak actual consistent. So until now, we have considered, in fact, two notions. We define a notion, a valuation that is market consistent, and a valuation that is actuarial consistent. So a natural question is, could we define a valuation that is market consistent and actuarial consistent? In general, it's not possible, because you have this dependence between financial and actual risk. If you consider, for instance, a risk, you should decide either you follow the information given by the market prices on the one hand, or the actual info. So an extreme case, for instance, would be, imagine that you have a financial claim and an actual claim that are like commotonic. Then if you want to be market consistent and actual consistent, you would need that the financial valuation is equal to the actual valuation. So this makes some inconsistency. So I will give a brief example to show you the difference. So imagine, for instance, that you have a portfolio of pure endowment. You have LX insureds, so Belgian insureds, and you look at the number of survivors after a certain time t. And imagine that you have a very simple financial market with no interest rate, and you assume that you have a Dutch longevity bond, and there is some dependence between the Belgian survivors and the Dutch survivors. Typically, if you apply this, and then we consider the most simple two-step operator is to apply expectation or P for the actual valuation and expectation or Q for the financial valuation. Then typically, if you apply the two-step actual valuation, you would easily find that you have the expectation or P, so that's the classical best estimate, that's what you would obtain with your mortality data. But then if you would apply the two-step financial valuation, so you inverse expectation or Q and expectation or P, and you condition on financial event, then in fact you would find that this is not the expectation or P, this would be a certain proportion of the Dutch longevity bond. That's logical. If you have a payoff on Belgian population and you have a Dutch longevity bond in the market consistent price will tell you that you have to invest in this longevity bond because you have some dependence towards this longevity bond. So just to go one step further, I made some very basic assumptions. So I assume that, for instance, you have this Belgian and Dutch population following a B-rate normal, and then for the Dutch population had added a certain market price of risk, and then you would see that typically the standard best estimate will give you like mu1, the expectation or P, where if you look at the market consistent value, by applying a two-step financial value, you would obtain mu1 plus this factor. So you see that the difference between these two-step operators will come from the dependence between Belgian and Dutch population via this rho. So, I mean, if you have a, okay, perfect, thank you. If you have a longevity bond and you are highly correlated to this longevity bond, you will have to invest in that bond. And also the market price of risk. I mean, if there is a high risk premium on this longevity bond, it will also be reflected in your market consistent price. Then we would like also to define a kind of regulatory fair valuation based on our two-step, which is closely related to solvency regulations. So the idea is that in Solvency II, I mean, this is not the definition in Solvency II, but in Solvency II you have this decomposition between a best estimate and a risk margin. In fact, if you use this two-step operator, you could also define also a best estimate. In our framework, a best estimate would be to apply, to condition on financial event, actual event, sorry, then apply expectation Q and then the expectation P for the outer operator. That would mean, this is a best estimate and expect the mean of your risk. And then also to look at what would be, in some sense, kind of solvency requirement for your risk. You can also consider this two-step operator and then apply pi2 here, an actual principle. So the idea would be that you have this best estimate, and for your SCR, for instance, you can say, okay, this pi2 would be a tail value at risk, and then here, in some sense, you would measure your deviation towards your best estimate. So then now I'll give a small example to illustrate. So I consider an equity-linked contract. So here I have some financial guarantee. So Y1T is a stock, K is a financial, a guarantee level. And then I look at the ratio here. LX are the number of policyholders. LX plus T are the number of survivors. I have some dynamics for a GBM for the risky assets. And then the force of mortality is some Horston-Euler-Bank process. And then I want to compare two types of valuation. On the one hand, I want to apply this two-step valuation, where I look at a best estimate plus some kind of cost of capital to measure the actual risk. And then as a kind of benchmark, I compare my valuation with the classical Brennan and Schwartz, where you apply expectation P for your actual risk and the expectation Q for your financial risk. And this would be what we would obtain. So the blue line is like the benchmark, where you have expectation P for actual risk, expectation Q for financial risk. And then this line is what you would obtain with our two-step actual valuation. So we see that in some sense you have this, the difference will typically, because here basically it's a kind of typical best estimate, but in fact when you apply this Brennan and Schwartz, you do not price the deviation towards the best estimate. And here we see that in fact there is this difference, and this difference will essentially represent the dependence between financial and actual risk. So because here, in fact, rho is the correlation between your stock and your force of mortality. And so we see that if there is some dependence between financial and actual risk, this could have some big impact on your valuation. So just to sum up, so we propose two kind of two-step valuations. On the one hand, two-step financial valuations, and on the other hand, two-step actual valuations, where we reverse the valuation order. And for each two-step operator, we provided some axiomatic characterization. So for each type of valuation, you can say that each valuation is, for instance, market consistent if and only if it has a two-step representation. And I think there should be some research about this two-step actual operator, because at the moment it was, I think, not yet investigated in the literature, and we believe it's can be a good framework for the valuation of insurance liabilities in complete markets. And some references. Thank you.